Explain the elements of business models. Distribution of value to key stakeholders. The distribution of value to key stakeholders refers to how the economic and non-economic benefits created by an organization are shared among those who contribute to or are affected by its activities. Once value has been created and captured through the organization's business model, the remaining value, often referred to as residual value, must be allocated fairly among groups such as shareholders, employees, management, government, customers, and wider society. Stakeholders have different expectations. Shareholders may seek dividends, employees may expect fair wages or performance incentives, customers value quality and affordability, while governments collect taxes to support the public good. Effective value distribution ensures stakeholders continue to support and engage with the organization, reinforcing sustainability. If value distribution is perceived as inequitable, stakeholders may withdraw support, leading to reputational harm, reduced motivation, conflict, or even regulatory intervention. Therefore, distributing value is not only a financial decision, but a strategic one that shapes long-term trust, legitimacy, and organizational resilience. The business model's cost and revenue structures strongly influence how residual value is shared. The cost model considers efficiency of processes, level of activity, resources consumed, and price paid for inputs, all of which determine how much value is available for distribution. The revenue model determines how the organization earns income from customers through pricing strategies, revenue sources, and payment mechanisms. Decisions in these models affect whether more value flows to internal stakeholders such as employees and shareholders, or external ones such as suppliers or government through taxes. Performance-related pay, profit-sharing schemes, and reinvestment into organizational development are examples of internal value distribution mechanisms. Externally, companies may invest in ethical supply chains, community development, or environmental sustainability. Distribution decisions also need to reflect the organization's strategic priorities, such as growth, retaining earnings, stability, maintaining cash reserves, or competitive positioning, investing in innovation. Transparent and consistent value allocation enhances credibility and stakeholder commitment. Distributing value requires balancing stakeholder expectations while ensuring the organization remains financially viable and strategically competitive. Key stakeholders often have competing priorities, and managers must make informed trade-offs. For instance, over-distributing profits to shareholders may leave insufficient funds for reinvestment, hindering future innovation and operational efficiency. Similarly, prioritizing cost reduction to increase margins may weaken relationships with suppliers or reduce service quality for customers. To navigate this, organizations use governance frameworks, stakeholder engagement processes, and performance management systems to ensure decisions are aligned with strategic goals and ethical standards. Mechanisms such as negotiation, communication, transparency, and shared purpose help maintain trust and clarify the rationale behind value distribution decisions. In high-performing business models, value distribution reinforces collaboration and encourages behaviors that contribute to long-term success. Ultimately, distributing value is a continuous process that evolves alongside the business environment, requiring ongoing review, monitoring, and recalibration to sustain stakeholder relationships and organizational performance.